What's going on, guys? Welcome back to another video. In this video, I've got another very important AMC update to bring all of you this evening. So what we're going to be covering in this update is a little bit of the Ortex short interest and utilization data heading into next week. Just how valid is it? What I kind of gather from the data that we're seeing here. But the most important thing that we need to talk about is kind of what's going on with these really large financial institution margin calls that are being sent out. We have UBS and now we have Credit Suisse. We started to talk a little bit about Credit Suisse when they started to cut the value of these Russian bonds. And if you remember me saying, in that previous video that we are going to see margin calls because of this, and watch out for more institutions starting to do this as well. Well, we finally have the notice that Credit Suisse is sending out some of these margin calls. We're going to go over the effects of this. And one very important thing that I want to kind of get across to everybody is just kind of the significance of margin calls. And we're going to kind of go back to this Archegos situation to just see kind of how messed up our financial system is. And it's even way much worse than we initially thought. So before we get into all of that information, if you enjoyed the information and analysis that I provide for you in this video, make sure you go down and hit that like button. It costs you nothing to do it, but it really helps us out a whole lot in getting this information out to as many people who want to learn. And if you guys want to see more videos like this, make sure you hit that subscribe button and turn on that notification bell so you're notified every time I post a new video. And again, guys, 1348, the strategy that everybody who has really taken the time to learn is absolutely crushing it with. You can get access to some free alerts down below in the description. So make sure you sign up. Go test it out, see how you like it. We are going to be leaving those free alerts on those 5 stocks up for a while. So make sure you kind of go in there and kind of put on those training wheels if you are interested in kind of taking your portfolio to the next level. So AMC closed the week on Friday at $16.57. Again, we touched upon this in yesterday's video, but down 8.25%. Obviously, not necessarily what we really wanted to see, especially coming off of AMC's earnings. But we are seeing a lot of big things moving in the global macroeconomic environment that are dragging things down and creating a lot of volatility in the market. Now, when we're coming over to Ortex right here, we're still showing 100% utilization, which I think is utter nonsense. We have cost to borrow at 1.34%. That's kind of why I see the utilization being kind of nonsense. I've said this in the streams a couple of times, that the institutions that if the utilization was a 100% and they were only charging 1.34%, they deserve to go out of business because they have the opportunity there, that scarcity aspect, to charge their clients a lot more money to take out loans of these shares. And they're saying no. I kind of liken this to if AMC were to get to really, really high prices, and then you just decided to go out and sell your shares at like 100. That's kind of similar to what we would be seeing here with this discrepancy between the utilization and the cost to borrow. But we're at 20.92% estimated short interest, 107.7 million estimated shares to be sold short. The only issue, it's not really an issue, but the shorts do have a lot of ammo that they can use against us if the market does start to freak out. There's 126.23 million shares currently on loan. So there's about 20 million shares that they kind of have in their back pocket. And again, the apes are going to need to step up if they start trying to sell these shares and really just kind of say, nope, we're not going to let you put this price, but basically move the price down. And in order to do that would be to kind of counteract with buying that could come from institutions, even the market maker hedging or retail investors kind of buying when these institutions are trying to short it down. Now, let's get into this situation with Credit Suisse. We're going to talk about UBS and then kind of the broad picture of how margin calls kind of have been working in the overall industry over the past year and a half and possibly even longer. So when we come over to this page right here, this article came out a few days ago, but Credit Suisse wealth clients faced margin calls on Russian assets. They joined UBS in asking for more collateral for some portfolios. That's essentially what a margin call is. All they're doing is saying, hey, you need to give us more money in order to hold on to this position. If you don't, we're going to liquidate it. And that is going to be where those forced liquidations come in. And that's kind of what we're looking for on the AMC side. Now, when you think about these margin calls being sent out, they are very important. You're going to see some of these institutions really take kind of a hit on this. If you are using Russian bonds as collateral, you need to think of kind of this collateral situation like this. let's say that you wanted to lever up on your position, which all of these institutions are doing. You have to put up a certain amount of money as sort of like a down payment in order to get the total size of the position. Now, there's only some sections of securities or cash that qualify as that collateral. It's called high quality something capital for the collateral that they are using. I forget the exact term for it. Some institutions are going to accept some securities, some institutions are going to accept others, and it looks like Credit Suisse and UBS were accepting some of these Russian assets and bonds as collateral. But what happens here is that when these institutions, Credit Suisse and UBS, start to kind of say that these institutions are either worthless or they're no longer going to accept them as collateral, the institutions that are using them as collateral now have essentially a worthless asset, meaning that they not only have to go out and purchase more collateral, but they may need to go out and purchase more high quality collateral in a larger amount than they did before if the overall position that they have is depreciating. So if they have a short, whatever they are holding was going up. If they have a long, whatever they were holding was going down, and that is what is triggering some of these margin calls here. We're going to have to kind of look and see what other institutions are going to be doing this, but right now we have Credit Suisse and UBS over here. But Credit Suisse is an interesting one that we really need to kind of focus in on. Credit Suisse has had an issue with letting their clients kind of take it too far in the past, and that has to do with Archegos Capital Management when they had that absolute blowout with Discovery, Viacom, and a couple of those other stocks that they were holding, where when Archegos got liquidated, the value of those securities absolutely plummeted by like 80+% when those liquidations went through. Now, the reason why that situation was allowed to go on for so long is because the banks don't really, Credit Suisse and UBS and all these other institutions don't really have the bargaining chip or the negotiating power in these transactions. If they allow their clients to lever up, they're allowed to collect more fees. They're allowed to collect more, essentially, percentages on whatever positions that they're holding. So then we end up getting situations like this. Archegos was too busy for margin calls. Now, we could easily say that this is going on right now, but the thing we need to look about here is on February 19th, 2021, the PSR analyst sent a dynamic margining proposal to the head of PSR for internal review, noting that he had made the terms about as tight as possible, yielding an average margin of 16.64% if applied to Archegos' existing swap portfolio and leading to a one-day step-up of approximately $1.27 billion in additional margin. This was less than half of the additional initial margin that would have been required if Archegos Prime Brokerage dynamic margining rules were applied to Archegos Swaps portfolio. Now, this is basically just saying that Credit Suisse was asking for more money. When we come down a little bit further, on February 23rd, 2021, the PSR analyst covering Archegos reached out to the Archegos accounting manager and asked to speak about dynamic margining. Archegos' accounting manager said he would not have time that day, but would speak the next day. The following day, he put off the discussion, but agreed to review the proposed framework, which PSR sent over that day. Archegos did not respond to the proposal, and a week and a half later, on March 4th, the PSR analyst followed up to ask whether Archegos had any thoughts on the proposal. His contact at Archegos said he hadn't had a chance to look yet, but he was hoping to look today or tomorrow. Now, what this is essentially showing here is that these big banking institutions don't really have enough kind of bargaining power in order to enforce some of these margin calls until it gets too late, because we know how this Archegos situation ended up. They kept delaying. Then Credit Suisse said, all right, I've had enough. We're liquidating your position. We're recouping what we need to recoup back, and you are going to be essentially taking significant losses. Now, comparing this to kind of what we're going on with AMC and GME and a lot of these other stocks, that easily could be happening right now, where these institutions are kind of trying to make backdoor deals where they're like, hey, we know you've been shorting this thing for a really long time. You're down significantly on your position. We need more money. And they're just essentially saying, yep, nope, sorry, we don't have time today. This is a massive problem in our system, because when you think about what happens to retail investors, if you get a margin call, there's no negotiating. There's no, oh, sorry, I haven't had a chance to look at this yet. No, you get hit with a margin call, you meet it, or you get liquidated. And that's how it should be for these institutions as well. So this isn't necessarily a doom and gloom video, because we know exactly what happened with the Archegos situation, where they ended up getting liquidated. Archegos took big losses, and they're essentially worthless now in terms of their fund. So we are kind of heading towards these kind of situations if a lot of this collateral is being used for a lot of shorts, a lot of long positions, and these big institutions are having a lot of issues. But again, like I've said for the longest time, this is going to take some time to play out. So that is mainly going to wrap up this update on AMC and this whole margin call situation going on with these big banking institutions. If you enjoyed the information and analysis that I provided for you in this video, make sure you go down and hit that like button. It costs you nothing to do it, but it really helps us out a whole lot in getting this information out to as many people who want to learn. And if you guys want to see more videos like this, make sure you hit that subscribe button and turn on that notification bell so you're notified every time I post a new video. So I hope you guys are having a great weekend, and I'll see you guys in the live stream tomorrow morning, bright and early, 8:30 a.m. Eastern.